Welcome to TheoTrade. This is Don Kaufman here doing the weekend update on September 30th, 2017. Let's get right to it with a look at the S&P. This happens to be a 30-day, 1-hour chart. The grind ultimately continues. And when I say the grind, what you happen to be looking at right now, as I said, was a 30-day, 1-hour, but you're looking at the previous, ultimately, 2 weeks of trade. Okay, the bracketed areas happen to be none other than the expected moves. So the expected moves, the last, and again, the previous 2 weeks of trade have been right in and around the neighborhood of about $20 expected moves. That means $20 higher or lower. Last week was similar. I believe the expected move is right around $21 higher or lower. And this coming week, okay, we're actually sitting at $19 and about 77 cents. Just to be specific over here, it's, again, even lower implied volatility that's driving markets in the coming week. So we're already kind of forward looking over here. And as I said to begin with, the grind kind of goes on. The range has been incredibly tight. For those of you that didn't hear this statistic, but we're coming off of the lowest recorded volatility ever, okay, in the month of September. Obviously, we're going into, October, starting out next week. It's a whole fresh month, but starting out October, we just saw the end of the quarter. The market has been an absolute, complete and total grind. Again, in the previous 2 weeks, the movement this week, and the largest move we saw was really Thursday. Ultimately, we grinded up to, this 25.09. And then, of course, Friday, with just moments to go to the close, the SPX shot up. In fact, if you take a look at this on a 1-minute chart on Friday, here we are grinding, for the most part, 10 points away from where we've been for weeks. And the last, again, few moments of trade, we actually shot up a couple extra points there inside of the S&Ps. Nothing too exciting, especially if you're trading options. Now, let's get to a little bit more excitement here. Again, we're sitting on an extraordinarily low implied volatility, of course, for this coming week. As I said, inside of the SPX, and people, this is the beginning of a new quarter here, and it's also a new month. So we're going to have the jobs report coming out on Friday, which is pretty shocking. You got a jobs report coming out. You'd think the implied volatility was higher, but we're sitting at like a 7%. Which, again, very, very shocking. Between now and like Wednesday, 6.6%. I've been saying this like each and every week, but we've never seen volatilities this low. Like nobody's ever seen volatilities this low. Now, granted, they never had Monday and Wednesday expirations. Those only began, okay, in 2016. In February of 2016, they added a Wednesday. Okay, in August of 2016, they added the Monday option. So nobody's ever seen like intra-week kind of expirations like this. And to see the volatility at like 6.6%, they're ultimately pricing in, well, absolutely nothing can happen. Nothing is going to happen. That's what's being priced in. What the reality is, it's a bit of a different story. So if you're looking for a little bit more excitement, sure, we can go over to the Nasdaq. Now, the Nasdaq lately has also been adhering to its expected moves. So even this week, we did have some action in the Nasdaq this week. There's the expected move inside of the QQQ, right? It was in the range of just about $2, and we almost hit the bottom of the range. In fact, we did on Monday, bounced off of it. Okay, we're well inside the expected move. For this coming week, we're also looking precisely at about a $2 expected move inside of the Nasdaq. Again, nothing too huge over there, but we are seeing some volatility in the Nasdaq. I'm going to come back to the Nasdaq in just a moment. What has been undoubtedly Mr. Toad's wild ride is the IWM. The Russell, okay, is doing wild things. In fact, I'll even apply my auto expected moves. These auto expected moves, what they're just elaborating upon, this is the week to week expected moves, okay, and this is 1, 2, 3, 4, 5, 6, okay, 6 of the previous weeks how often are you supposed to move outside of what's expected? Well, these expected moves are supposed to encompass about 68% of all occurrences. But if you start to kind of highlight them here, you'll actually see really, really quickly, this is outside the expected move. The next week, outside the expected move. Okay, we got one inside over here. Here we go, outside the expected move. Undoubtedly outside the expected move. This week, outside the expected move. So in 6 expiration cycles, again, 1, 2, 3, 4, 5, 6, okay, you have 5 out of 6 that are ultimately outside the expected move in the most recent weeks. I mean, what that basically entails is if you bought options in this product, you made money. Now, what options did you have to buy? Basically, if you bought a straddle, you made money, okay, in these most recent weeks. Does that mean, you know, it's going to be forward looking out there? And absolutely not. It doesn't mean in this next week we're per se going to make money. If you look at IWM though, and you look at the option chain, the implied volatility there is also still, it's incredibly low. It's about 12%. Okay. 12% $2 expected move on a $148 product. You know, how does that compare to the Nasdaq? Well, the Nasdaq's a $145 product. It too has right around about a 12% and a $2 expected move. Between the Nasdaq, okay, and the Russell, the expected moves are almost identical, as the products themselves are almost identical in terms of pricing. But what you might want to think about doing is, you know, the Qs have been inside the expected move. The Russell has been outside the expected move. Could actually sell over here in the Qs, buy something in the IWM, because right now, undoubtedly, the S&Ps are dead. Now, let me switch gears a little bit and start talking about some individual stocks over here, because I like to cover a lot about implied volatility. I mean, people, this is what's driving the market now, right? Low implied volatilities, okay? When I say it's driving the market, traders are still adhering to these expected moves. Again, if you take a look inside of the SPX, in some of the most recent weeks over here, week after week after week, we adhere to the expected moves well beyond what statistics tells us about those. Now, let's switch gears a little bit. And I was talking a bit about the Nasdaq a moment ago and saying, yeah, you know, it's the Nasdaq has tamed down and toned down, I should say, a little bit. But one thing that really strikes me is in taking a look at this chart, and again, these are the Nasdaq futures, whether you trade them or not at issue here. So we've rallied up after seeing what looked like the possibility of a harsh sell-off on Monday, a complete change of tone. We rallied back up. So we're facing almost all-time highs inside of the Nasdaq. Okay, we have all-time highs, okay, inside of the S&Ps, and I'll even turn off here for a moment these expected moves. We're at all-time high in the S&P. We're facing all-time highs inside of the Nasdaq. But one of the things that really strikes me is the underlyings that are driving the Nasdaq. Specifically, if you look at something like Apple, I mean, do you see Apple on a year-to-date, you know, performance over here has kind of fallen from grace a little bit. So Apple is not going to be a driving force. You start looking at this, and you're like, all right, so Apple is not taking us to new highs inside of the Nasdaq. Okay, Facebook is an area of strength inside of the Nasdaq. Okay, we'll come down to Amazon. Amazon clearly is not one of the stocks that's driving the Nasdaq to almost all-time highs. Google, okay, all of a sudden out of nowhere, Google has been a non-performer as of late. Out of nowhere, now you're seeing capital shoved into Google. This is one of the reasons, again, that we're seeing, and Google is at the forefront of the most recent move in the Nasdaq. Again, so I started looking at this and trying to be as objective as I possibly could. And I'm looking at, you know, all right, Microsoft, but it's not at all-time highs. And then again, Apple, which is falling quite a bit over here. And you just starts to beg the question, what is driving the Nasdaq at this point? We've seen these wild rotations of capital. Almost feels like the markets are manipulated. And I've gotten a lot of emails to that effect. They're like, who is manipulating this? It's not about manipulation. It's about driving capital, okay, into big market caps to ultimately produce performance of the entire Nasdaq. So without Apple performing well, okay, I'm looking at this and again, trying to be objective. I'm like, what is possibly driving markets in the Nasdaq specifically right around all-time highs. If Apple is your biggest tech stock over there, it accounts for a huge market cap inside of the Nasdaq. How is the Nasdaq at an all-time high? So did a little bit of research, and here you go. You haven't seen this one in a while, have you? That's because nobody's looking in the backdrop of what's really going on. Okay, there is capital rotations. It's Intel. Intel is one of them. Okay, this is a year-to-date percentage. And if you zoom in real tight over here, this is where a big rotation of capital is moving right now. You realize Intel was down year-to-date almost 6%. Yeah, and now ultimately is what? Up 4%. The market cap on Intel, it's huge. It supports this logic. But Intel alone is not nearly as big, of course, as an Apple. So I started doing a little bit more. Okay, go take a look at Cisco. It's the exact same thing. Like nobody even remembers these companies, right? It's Intel and Cisco. They're driving capital into the non-performers. And it started in pretty much the exact same days over there, whether it was Intel, whether it was Cisco. And they're actually driving, and I say they, it's portfolio managers. They're just driving performance of the Nasdaq by buying whatever they possibly can. And, there's times in the marketplace, and again, I am, this is the non-objective part of this conversation. I am the consummate bear in here, and being a little bit bearish, I'm always looking for signs like, is the market going to top? Is the market going to top? When you start seeing portfolio managers force returns, okay, in this fashion, I mean, this is absolutely like terrifying to me. All of a sudden, Google is out of favor. Yeah, until there's nothing left to buy. They realize Apple isn't performing. They've put money in the coffers out there in what? Intel and Cisco. And then they go, wow, it's, Google's not performing. Might as well just buy some Google over here. And Google, again, just this week, Google was up, 14%. It's actually shot up to over 20%. I mean, from low, this week, from low to high, these kind of percentage moves, not only aren't they normal, they're dangerous. And you're seeing it, again, on heavy volume out there, okay? So, again, I'm showing you this, like, forcing capital to work. And you're like, well, why do they have to force capital? If you look at portfolio managers ultimately, they have to go out and they have to vest about 95% of everything they get in. What that means is if you have a mutual fund, which everybody contributes to the 401k, you got a mutual fund. In the prospectus of the mutual fund, it says that mutual fund manager has to continue to vest about 95% of their funds. As long as the money keeps coming in, they have to force returns. It's not about being prudent. They don't care about like prudence. It's about forcing returns at that point. Okay, it's the school of what's working now, and it totally explains the moves that we're seeing right now in Google. It explains what you're seeing in Intel. It explains how the Nasdaq is at highs, but it also explains the scariest move we've seen yet, which happens to be inside of the Russell. Okay, so people are like having conversations. This is bubble. This is this. Forget about that idea. It's all about right now throwing caution to the wind, and portfolio managers are just shoving capital in. Okay, to produce returns. Now, the question always looms, when does the music stop? Well, right now in the Nasdaq, if you want to know when the music's going to stop, you got to keep your eye on Google, Intel, obviously Cisco. That's the point of this conversation, okay, is when markets ultimately turn, okay, is up to what? Is this rotation of capital going to continue? Or are they going to start shoving, capital into, to the coffers of something else? What's driving the S&Ps? You don't have to look very far. The SPX is being driven exclusively by the financials right now. All of a sudden, they're the hottest thing on the block once again. Why? There's nowhere else to put money. There's just not anywhere else to put money. I'll show you something other that's interesting on this logic over here. This happens to be the XLE, the energy sector, right? So the energy sector has just been like decimated. That's the only thing you can say. On a year to date, was down almost 20%. Now it's only down 10%. Okay, so something that was heavily out of favor is now in favor. The one thing that really strikes me, though, in terms of energy is ultimately, first of all, these, the energy stocks themselves, they're not really tracking that much with oil anymore. Oil has just been bouncing around. It was down 20%. Now it's only down about, 1.5% kind of year to date. But I'm going to show you something. This is going to be a little bit confusing first time through. We're going to talk about correlations and so forth, okay? And to do this, we'll come back to oil and energy in a moment. We're going to go over to GLD just to make a point. We're going to take a look at gold. I've got a style preset in here, and we're going to come up to dollar comparison and correlation. What you are looking at, and again, just to understand some of the insanity, if you will, of the marketplace in its current state. What you happen to be looking at right now is, again, this happens to be the dollar. Here is ultimately gold, and this is the correlation, okay? And what's the correlation ultimately mean? Well, you can be positively correlated or negatively correlated. Typically, what you see is when the dollar is going down, gold is going up. That would indicate a negative correlation, and the negative correlation is usually about -1. If it's a strong negative correlation, that means one product ultimately goes up and the other product goes down almost in perfect tandem. So when the dollar drops, okay, gold should go up. Now, you can see some of the fluctuations of this correlation over time. Now, the only reason I'm really showing gold versus the dollar is because you would expect a lot of the commodity products, like what? Energy, oil specifically, to follow kind of suit in here, right? But you couldn't be anything further from the truth. If I pull up now XLE, okay, if you pull up XLE, not only aren't the energy stocks, all right, and energy stocks, again, they're not exactly oil, but throughout history, these live, okay, typically in kind of a negative correlated world. What we're seeing right now is one of the highest positive correlations ever recorded between energy and the dollar, okay? It is striking at this point. Again, energy versus the dollar, how positively correlated they are. Like, okay, so what's the opportunity over here? Well, when you see energy versus the dollar positively correlated, again, I can even pull this back on a 10-year monthly. This is over 10 years. Again, most of the time, these live in a negatively correlated world, right? When the dollar gets strong, energy gets weak. Why? Strong dollar pushes oil down, hurts the energy stocks. When the dollar is weak, and the dollar has been very, very weak lately, right? So when the dollar's weak, what do you get? Oil that goes up helps the energy stocks. Right now, dogs and cats living together because they're positively correlated. And this is when you just have to kind of shake your head at. Again, signs of insanity in the marketplace, they're bubbling up everywhere when correlations that we've been looking at for over decades are not only broken, but all of a sudden positively correlated. It's, again, the other side of, throwing caution ultimately to the wind. Again, all I did in that particular circumstance is I just built a style and, correlated aspects over here. Again, there's a lot of correlations you could build, but I really like the dollars comparison and correlation. Last but not least on this front with the dollar comparison, I'm going to bring up EEM, okay? EEM has also been fairly wild lately. For those of you who do not look at this, this is the emerging markets. Again, emerging markets have an incredible sensitivity to the dollar. So again, if you take a look at the comparison, here happens to be the dollar, here is emerging markets. Right now, they're sitting at almost a perfect -1 correlation. That's what you would expect, okay? Weakness, again, weakness in the dollar brings strength to the emerging markets. Now, the dollar got strong this week. Emerging markets, what? Okay, they're all over the place. They start to break down. At this point in time, again, even these correlations, okay, have still been all over the place over time. Now, if I bring up a little bit of a longer time frame, bring up that 10-year monthly in this particular circumstance, okay, here's something that is, okay, working right now in terms of emerging markets. So the reason I'm bringing this up in emerging markets, and I'll kind of clear the comparison to over there for those who are not that into it, the emerging markets are moving based and predicated on what the dollar is ultimately doing. So at this point in time, if you think this is just a pop up in the dollar and the dollar is going to continue to fade, okay? If the dollar fades, what happens to emerging markets at that point, right? When I say the dollar fades, if the dollar turns around and starts to continue to sell off, the emerging markets may have some legs and head back to the upside. Okay, at this point, I am taking the other side of the trade. I'm actually short. Again, I'm short in the emerging markets over here. I happen to be looking for a bit more strength in the dollar as it has come down. It has been a long road to the downside. I think the dollar may dip one more time and then take back off to the upside. Last but not least here in this weekend video, the next area that we really need to focus on happens to deal with bonds. Bonds have sold off an extraordinary amount. And, you know, I pointed out a little while ago that it's really the financials that have taken, okay, the S&Ps ultimately to new highs. But in kind of retrospect, it's not necessarily the financials, okay? The financials are just a victim of the performance of the bonds, if you will. And what that means is the financials are ripping to the upside, but is that because they're great to buy right now? Like, you know, has Bank of America actually figured something out? No, they have nothing to do with it. It's just a function of interest rates, okay? The bonds, they've started selling off, which brings interest rates to the upside over here. The S&P itself, now if you're looking like, you know, big picture here, the S&P itself right now, we know is being driven by financials. That's what's taking the S&P to all-time highs, right? Which really, okay, means that the next move in bonds is everything. If bonds turn around, again, if bonds turn around, get bid right back up over here, okay, then we'll actually see the S&Ps come off their all-time highs and start to come down a little bit. In this coming week, this is the marketplace you want to focus on the most. Right now, it's all about the bonds. That's what's driving the S&Ps, okay? Also, keep an eye on those relationships. You know, Google, Intel, Cisco, those are your three stocks right now, ultimately driving returns inside of the Nasdaq. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.